Another batch of positive economic data helping drive another day of gains for stocks. For more on the markets, we're joined by Erin Browne, PIMCO portfolio manager. Erin, it is fantastic to see you. Thanks for being here. So let's talk about this now comeback of optimism to the market here. Do you still expect some volatility going forward, or does it feel like things have sort of stabilized?
I think for the very short term, things have stabilized. We've gotten a slew of data that's been better than expected, particularly after the payroll print, which really sent market into the downward price action that we saw. Since then, the data that's come out has all been suggestive of the fact that the economy is growing but slowing, and that the Fed is on pace to cut rates starting in September at a quarterly pace of 25 basis points. We probably get 3 cuts this year and another 4 next year. All of that said, I think as we move into the fall, particularly as we move closer to the election, there is going to be more bouts of volatility. I would say that as an investor, I would fade those bouts of volatility unless we start to see the economy really sliding towards a recession. But for now, the economy seems to be on track to a slowing trend, but still very much in positive territory.
Erin, we're going to hear from Fed Chair Jay Powell next week at Jackson Hole. What do you think and other investors are going to be sort of keying in on most closely in his commentary?
Sure. So Fed speak of late has suggested that the Fed is likely to start cutting rates in September. I think that that's well understood by the market. The market is now pricing in a little bit more than a 25 basis point cut. Starting in September, the market's pricing at about a 30% probability that the Fed cuts by 50 basis points. We think that that's unlikely. So I think you'll likely see the Fed affirm that they're on track to start cutting at a reasonable pace that's data dependent. I think what the question mark is going to be is how that extends into 2025. Market pricing right now is fairly benign. The market is expecting in 2025 that the Fed cuts at a 25 basis point quarterly clip. We think that that's likely accurate, but how the Fed responds to weakening data is going to be, I think, what's the market's really going to key in on, as well as how they think about the balance sheet as well, if we get any more clarity around that.
So given that there is still that uncertainty that could result in those bouts of volatility that you talked about, let's talk about where you think investors should be positioned right now, right? I know that you are still kind of looking at the AI trade right here. Mm-hmm. At this juncture, where do you look? You know, we still have, even with the pullback, you know, you look at Nvidia, it's still more than doubled this year.
Absolutely, but I think that the earnings are coming in and suggestive of the fact that 2024 in the back half of the year and into 2025 is going to still be very robust earnings backdrop for many of the AI companies, specifically those that are really invested in the infrastructure and hardware build out within the space. What we saw coming out of earnings season in the second quarter is that the hyperscalers are still very much investing heavily in CapEx and into R&D in the next year ahead. All of that is going to be very supportive for earnings for the semi-chip conductor names like Nvidia that are really supporting the growth in this sector. So I think you stay invested in the infrastructure names within the AI sector. I think you're going to continue to see earnings be revised upwards as we head into, particularly into 2025. In addition to that, I think you're also starting to see a broadening out of sector participation in the market. We saw that a little bit in the second quarter of this year, but we really are focused in our book on those stocks and those sectors that are geared towards the middle income and the higher income consumer rather than the lower income consumer, where we're starting to see some degradation in the credit data.
One of the other areas that you like that I honestly have not heard people talk about a lot in a while is the Kospi, which is the Korean stock market. It hasn't done much this year, much of anything. So what do you think would change that?
Sure. So I think one of the things that's been holding back the Kospi is the fact that it is about 13% of the weight is in the EV sector. And we've seen that come under a lot of pressure over the last year or so, particularly over the last 6 months. However, the majority of the Kospi, about a third of it, is in the semiconductor chip sector that is very much levered to the AI theme. And historically, you actually see the Kospi trade pretty closely correlated with tech and with AI. It's decoupled over the last year and a half, but we think that that's likely unjustified. And I think that going forward, you're actually going to see an accelerated move to the upside in the Kospi, particularly now that we've seen a lot of these EV names get bottom out. And so it's a name that we think is cheap. They're doing a lot in terms of the value up proposition, in terms of corporate reform, which is not yet being rewarded by the market overall. And we think that there's a lot of potential for positive earnings momentum coming out of the Korean stocks, particularly out of the tech sector, which we think right now is very undervalued relative to how this tech sector is trading in the U.S.
Interesting. And then coming back here to the U.S., Erin, if there is any kind of defensive posture that people want to take here, given that we could see some choppiness ahead, I know healthcare is one of the spots that you like, and that that's something that we've sort of increasingly been hearing from the people we've been talking to as well. Why do you like it?
Sure. So healthcare came under significant earnings pressure last year. A lot of that was largely due to base effects as we saw some of the pandemic level spending wane. Coming into this year, we're seeing a much healthier earnings backdrop for the healthcare sector. We think that it's undervalued. It's been cheap, but we think that we'll likely see some catch up, particularly given that many of these stocks trade with a high dividend yield, which we think that as rates come down is going to be supportive of the sector. So healthcare, we think, is a great place to take a little bit more of a defensive stance. The other place, which you mentioned earlier in your segment, is real estate. It's underperforming today, but as we sort of see mortgage rates come down, we think that real estate and the REIT sector more broadly will start to have a little bit more of a positive sentiment underpinning it. And we think that REITs are also be a really good place in a lower rate environment to outperform.
Interesting. All right, Erin, lots of good ideas. Thank you so much for joining us. Appreciate it.